It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard. I am your host. Thanks for being with us. I'm also one of the certified financial planners on the show. With me in the KFG studios, my business partner and colleague, Josh Gregory.
Good to be with you, Mike.
Yeah.
Well, have you started your tax planning for this year yet? If you haven't started yet, it's getting kind of late, but not too late, thankfully. So today, we're going to help you jumpstart your year-end tax planning process with our special guest and CPA Ryan Fair.
That's right. Ryan's back in the studio today. We're going to talk all sorts of stuff about tax law changes and demystify all of this for you. If you have any questions, gosh, taxes create a lot of questions. We'd love to hear from you. We'd love to answer them on an upcoming show. If you're dealing with something specific for you and just need some help, reach out to us. You can connect with Ryan, and he can address your question right away. You can find us online, wisemoneyradio.com. You can call or text us, 574-222-2000. That's 574-222-2000. And all over social media, Twitter, Facebook, YouTube. We've got the YouTube channel rolling. Every episode's right there. You can reach out and connect with the show. Each of those ways, just search Wise Money Radio. Welcome back to the show, Ryan.
Hey, thanks, guys.
Glad to have you back. He needs no introduction just because we've done it way too much. He's a CPA and CFP, though, which makes him a rare find because he knows the tax code. He likes the black and white of the tax code, but also was a financial planner and still carries that designation, does a lot of continuing ed on that too. So he's aware of planning opportunities to look for ways to improve your tax situation. Speaking of, you guys know my rule. Every time you get your taxes prepared in the spring, you've got to answer 3 questions. The first one is this return accurate? So do I know where the numbers came from? Is it right? The second question you need to answer is there anything I can do right now to improve last year's return? So Ryan, and actually KFG, we specialize in that. You need to answer that question. And then the third we're hitting today, and that is, all right, this upcoming year, what's changed? And what new opportunities exist that I need to go after?
I like those 3 questions because just the act of asking those questions is what helps you link your tax planning with your overall financial life.
That's right.
And if you divorce those two, if you take your tax planning, you separate it from your overall financial planning, you're going to make financial mistakes, tax mistakes. It could be that you file your taxes wrong. I hope that doesn't happen, that you are getting the right numbers in the right boxes every year and whatnot. But more likely, you're going to miss tax planning opportunities.
Yep.
Those mistakes of missed opportunities are a big deal, and it's one of the reasons why it's important for your CPA and your CFP to be working together. That's what I love about Ryan. Having the CFP and CPA behind your name makes you extra nerdy, my friend. Nerd on steroids here today.
It's true.
But many people, their CPA and their overall financial life are not integrated together. Their CPA is someone that they see once a year in the spring, sometime between February and April. And if that's all the time that you get with your CPA, when their hair's on fire and their life is busy, they might not be bringing their very best creativity to bear in your financial life.
Or any creativity, actually, at all, because they're just trying to get the right number in the right box and get it out quick to move on to the next one. Nothing wrong with that, but it's a busy season for us too. But you need to be proactive. Those 2 questions the second and third question are about being proactive.
That's right. Your CPA may not know all the areas that you could be improving your tax picture because many of these hidden gems are located in other areas of your financial life that they may not have a glimpse into because you don't have the time to give them that glimpse. And that's, not to put a plug in for Ryan here, but one of the things I love about working with you, Ryan, is the ability to collaborate. And that's harder to do when your financial advisor or you don't work together on a regular basis.
That's right.
It's not going to be as efficient. The process isn't as refined when you don't have that kind of time together.
So most CPAs are slow right now. It's the fall. We're past October 15, and Ryan's shaking his head almost out of envy here because you and your team, this is not a slow time for you. Why
No,
is that?
No, envy is a good word, Mike. Every year I go to these conferences and talk to other, accountants, and, they, only work, from 9 to 3 throughout the week and take Fridays off. And then there's me. I'm, broken down in tears crying at these continuing ed
Oh,
conferences.
martyr.
So,
Ryan's a
yes.
martyr, too. I forgot
You
to
at
tell
least
you
go
that.
to 3:30, right?
Yeah, 3:30. Yeah, well, a couple hour lunch in
But it
between.
is busier.
No, it is busy. Right now, we are, we're cranking on tax projections. So tax returns, those are done. We just finished, everything through October 15th for everybody that likes to extend. They finally got us the rest of their stuff to finalize the returns. And now, instead of tax season, we call it tax projection season around the office. And so, yeah, literally, we've done hundreds of projections in the last, few months to prepare clients for the upcoming tax season that comes after the first of the year.
So that's the voice of CPA Ryan Fair joining us today on the Wise Money Show. So guys, and Josh, maybe just for the people who are not familiar with the term tax projection, what is a tax projection and why is it so important?
Well, the tax projection is just a forecast, or it's our best guess as to where your tax return is going to land this year. And you're running it usually in the second half of the year. Before we get to December 31st, you want to know or have an idea what kind of opportunities still exist between here and the end of the year. And also, are there any surprises that could be coming? If you wait all the way until March to figure out what 2018 did to you, this of all years may be the year of some surprises.
Yeah.
For some people, it'll be a positive surprise. Others, unfortunately, they're set up to have a nasty tax day this year because of some of the tax reforms and their employer's response to it.
So Ryan, what's involved in tax projection? What sort of information do you need in order to do an analysis like that?
Yeah, so tax projections, we gather all of the year-to-date information, best-known information. So if clients are still working, we get their current pay stubs, project out through the end of the year to predict what their W-2 will look like at the end. If they're retired, retirement distributions, from IRAs, pensions, annuities, any of that stuff, Social Security, and we project out what we think, the final numbers are going to look like for the year. And so, once we do that, we start. It's pretty much like doing a tax return.
It really is, and we've argued with you actually internally inside the walls at KFG about this because no, this should be simple. It's just a projection. And no, it's really like creating a mock tax return.
Yeah.
And even with a little bit more work, because you're not just taking the numbers off the W-2, you have to actually create the W-2. Right. And just thinking, well, I know how much I'm going to make for the year. That's not it, because how much are you going to have withheld? We're going to talk about that in a minute. I think there are a lot of people who have a surprise brewing. And so, but it's really to do exactly what Josh said. I'm sort of in his sound bites. Tax projections allow you to identify new opportunities early so that you can take advantage of them, and then helps you avoid surprises. Well,
so here are some people who maybe need to be thinking about a tax projection. Really, it's everyone this year who's still working, because the tax reform has maybe improved your tax picture, but your employer may have started reducing the withholdings that are being pulled out of your paycheck. But what about someone who's selling a business or someone who's changing jobs? Anyone who has their health insurance through the Affordable Care Act or the marketplace, you need to be doing a proactive tax projection. Anyone who lost a spouse this year or someone emerging from the college years, any kind of material change in your life really should drive you to do a proactive tax projection like this so that you know exactly how your tax picture has changed before it's set in stone at the end of the year.
Quickly, Ryan, what would you add to that, or any common themes that you're seeing as you're doing projections this year?
Well, yeah, we're going to talk about a lot of them with the withholding adjustments through payroll, and then this was the biggest tax change in years,
yeah.
And it's coming through for 2018, and so it's going to be impacting everybody.
Yeah, so not that I would disagree with Josh. I've just learned, even when I just always agree with him because he's usually right. But yes, that list, if you've been in a life transition, changes. Even if your company asked you to fill out new withholding forms, W-4s, or you switch jobs, But I would even say beyond that, everyone needs a tax projection this year. You do, because your situation's changed regardless. How? We're going to talk about what those biggest tax changes are and how you can prepare. That and more coming up here on Wise Money with Korhorn Financial Group. All right. Good. What?
Guess Josh didn't think so.
No, that was good. Ryan, good job interjecting, and that, yeah, it all sounded really good.
Make sure you stay close to the mic.
Oh, yeah.
At first you leaned back.
Yes, you need to stay very close.
Ice
So
cream cone?
we actually did. So yeah, you want to talk into the middle of it if you can, and we went through a stretch. So Ryan's guest today, obviously. Next week is a special edition of the Wise Money Show. It's me.
It's not more special than me, though, is it?
No, less special. You're right.
Okay.
You're right. And we're going to be talking about financial planning for millennials. And so if you're listening to this on YouTube and you've got some youngsters maybe living in your basement, I'm just kidding.
Or oldsters.
Or oldsters or whatever. But we're going to talk about the financial habits. And so actually we're going to be inviting 3 other team members from KFG who are all millennials and at different stages of being financial planners to share some wisdom. But anyway, we had a stretch where we had lots of guests on, and we had listeners say, I couldn't hear them because they were talking over here. Or they'd be moving and talking over here.
Rookies.
Yeah. So. All right. Is there anything additional to hit on tax projections? Okay.
I don't think so.
Josh, can we start with just a side comment about markets? Or no? Just a quick address of, I know the market's been volatile. Just a couple weeks ago, we talked about what to do in a volatile market. If you have concerns, reach out to your certified financial planner. Make sure you're taking the right amount of risk. If you just want to know some tips about being in a volatile market, refer back. I think it was 3 or 4 weeks ago we talked about it. Can we start with that?
Sure.
Okay. And then we'll just go right into, all right, Ryan, what are the biggest?
So we're going into the segment 2.
Yeah.
Changes for individuals and stuff. Okay.
Yep. And we've got the whole segment to talk about that, so you don't need to be fast and be.
Okay.
Yeah. All right. How are the new tax laws going to impact you? And are you prepared, most of all? Have you done a tax projection? You know exactly how it's going to impact you, and you're ready. There won't be any surprises. We're helping you with that today. This is Wise Money with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard, here with me in the KFG studios, Joshua Gregory, and special guest, CPA and CFP, Ryan Fair. Want to say thanks to the attorneys at Ledoux, Curran, and Keene, as well as First State Bank for making the Wise Money Show possible. Thanks very much. If you have any questions, we're talking about tax planning. Tax planning is confusing. There's lots of changes. Likely you have questions. You can find us online, wisemoneyradio.com. Just submit a question right there on the right. It goes directly to me and an email. And if it's something about your personal situation, we can get back to you. If it's something just for the show, we can address it on an upcoming show. Same thing. Call or text 574-222-2000. That's 574-222-2000. And then all over social media, you can connect with the show. You can watch every episode on the YouTube channel. So Facebook, Twitter, and YouTube, just search Wise Money Radio. Before we continue the topic of tax planning and talking about the changes going on in the tax world, the stock market's been a little bit more turbulent recently, and it's been an interesting year anyway. And so let's just quickly address that a little bit.
Well, I think maybe a reminder that just even a couple weeks ago, we had an episode where we were talking about volatility and what your response should be. But if you're feeling nervous in any way, when you look at your investments or you hear about all the noise going on in the markets on any given day, it's maybe a time to dial back in, refocus on your overall financial plan, and make sure that you're having the right response. So I would encourage you, if there's any of that heartburn going on as you look at the markets, now's the time to be reaching out to your certified financial planner. If you don't have one, you can feel free to reach out to us. We'd be happy to give you an opinion on what maybe your next step should be. For some of you, there may even be a tax-related response. So it's great that we've got a CFP and CPA on the show with us today, Ryan Fair. But making sure that your investment approach and your tax planning approach are integrated together, it's one of the hallmarks of taking a comprehensive approach to financial planning. And I know Ryan gets that. That's why he's on the show today.
That's right. That's right. Well, all right. Every year, tax planning is absolutely critical, but this year it's a must because everyone's tax situation has changed due to these sweeping new tax laws. So for individuals, let's start talking about some of the highlights. Ryan, what are some of the big changes that really could impact you when you're doing your projection and so on, your planning, that you need to be aware of so that you're not surprised?
Sure. Yeah, like you said, this is the biggest change that's come through in a bunch of years that relates to the tax situation of really everybody. At some scale, this is going to impact everybody that's going to file a tax return. So first and foremost is the standard deduction. That's the one that it's going to impact everybody. Standard deduction is basically a deduction or a coupon of money that you don't have to pay tax on. And for a married filing jointly couple, that standard deduction is all the way up to $24,000. For singles, it's $12,000. So if we just go back even to 2017, the last tax returns that we filed, for a married filing jointly couple, the standard deduction was $12,700 and $6,350 for individuals.
So it basically doubled,
Right,
essentially.
it did. It doubled across the board for everybody.
There's a lot of folks, because of that, they won't be itemizing their own deductions. They're not going to build their own write-off by keeping track of certain expenses. They're going to take the freebie option that the government is offering.
Yeah, you take the larger of your standard deduction or itemized deductions, and whichever one's bigger is better for you, and so that's what you take as the deduction. So,
You know a group out there that's really nervous about this? Churches and charities. Because, I think everyone's holding their breath wondering whether or not the gifts that are given and written off on your tax return are because of the tax savings or just out of the generosity and the support coming from someone's heart. And I'm counting on the second one being true, that people are going to keep on giving. We're coming into the holiday season, and that often serves as a reminder, you know what, I want to support that charity again. But you may or may not get a direct tax write-off for that this year if you're no longer going to be itemizing your deductions. That doesn't mean don't give now.
Absolutely.
And on top of that, we covered this in an earlier show as well, but you can reach out to us or your financial planner. There are some other creative ways to give yourself a better chance at writing those off, some planning techniques that we can help you with in order to make sure that you do so. But there's a trade-off, though, Ryan, with this higher standard deduction. What do you lose?
So the thing you lose is exemptions. So basically an exemption in earlier years, you would take a deduction, 2017 is $4,050 as a deduction from income for every person in your household. That was the benefit of claiming a dependent in years past. So you would claim a dependent, you get a $4,000 deduction from income that you don't pay tax on.
Yep.
Now they've eliminated the exemptions and lumped them all in with the standard deduction.
Yeah, this is one of those tax write-offs that used to be based on the head count in the family, how many people are on the tax return. And for families with a bunch of people under their roof, all of a sudden, you start doing that math. $4,000 per person goes away.
Right.
That's a significant tax write-off that's eliminated.
Very significant, yes.
Correct. So Congress knew that. They were thinking, believe it or not,
No,
I know,
they
I know,
weren't
I
thinking.
know. It's shocker. In context here, though, they were planning ahead, and they changed the child tax credit to help offset that loss. So child tax credit, what in the world's that? It is a tax credit, which is different and better than a tax deduction. So credit is a dollar for dollar reduction in the amount of tax that you owe. Prior to 2018, every child that you had that was under age 17 at the end of the year, you received a tax credit for $1,000 per kid. So if you owed $10,000 after your tax was calculated, you would get a child tax credit of $1,000. It would reduce it down to $9,000 that you would owe the government. So that was $1,000 per child that was under age 17. So Congress jumped that up to $2,000 per child, which is huge. It's a credit, $2,000 per child.
Not necessarily a reason to start having kids,
Absolutely not.
but makes it a little less financially difficult.
You know, they
A
also
little
made
less.
it better in the sense of not only doubling it, but there was a whole group of middle-income families out there that never got the full benefit of their $1,000 per child credit in the past because they would get phased out after their income reached too high of a limit. Now they've dramatically quadrupled that level.
Yep.
Right?
Yeah, the phase out started before at around $110,000 for a married filing joint couple. They stretched that all the way up to $400,000 before you get phased out or start getting phased out of the child tax credit. So
So it's going to help a lot more people. If you're a married couple and you're both working, you can get to that 110,000 limit pretty quickly and have this being phased out. So it's going to impact you.
and it helps the lower income too. The $2,000 child tax credit that we're talking about is a non-refundable credit. So what that does is it reduces your tax down to zero, but a portion of it, a smaller portion of it, is called a refundable credit, which means you still get money back even if your tax liability is zero.
And that's been increased.
It's
because-
increased.
Yeah.
So yeah,
that's
it's up to
right.
$1,400 per child is a refundable tax credit.
Yeah.
So that credit can not only wipe out your whole tax bill, but actually push you to negative tax, in other words.
Yeah, you get a refund above and beyond your withholdings and
Wow.
What's this family dependent credit though, and how does that work?
So yeah, family dependent credit. So again, we talked about exemptions. You got that for everybody that was a dependent in your household. Child tax credit went away in the year that they turned 17. So kind of to help offset that dependent exemption thing for the people the dependents in your household that were over 17 or above. They added a new credit that we haven't had before. It's $500 per person, again, as a tax credit that you get back for other dependents that are either 17 or if you have, mom and dad or grandpa and grandma living with you that are truly dependents, there's this other family tax credit.
You see what I'm talking about? You need to do a tax projection this year.
Yeah.
You need to. I mean, this is going to impact so many people, and we're not even halfway through the changes. On top of that, what if you're a small business owner? And I'm not talking about just owning a small business. I'm talking about self-employed or having rental properties. We're going to talk about those changes as well, things you need to be aware of. That and more coming up here on Wise Money with Korhorn Financial Group.
Don't touch.
Just helping you out.
I was up on it, wasn't I?
Yeah, but you were talking into the side of it.
I was aware of that, but I could hear you clearly. So I don't know how it came through. And
Yeah, I'd be more
Casey will
concerned
fix
about
it.
how it'll come through on the air.
so let's hit a couple of other individual ones. We're still just starting the third segment, and then we can transition right into the business ones. So because one of the things I hadn't even bulleted out is, okay, after that, your tax is calculated at lower rates, and so you might want to hit that too. And then that can feed into, okay, here's the big warning because of withholdings.
Yeah.
Right. So
Yeah,
we
that's got to be covered.
we got to hit that, and then we can slide into businesses. I figured this one would stretch beyond just one segment. So, all right,
Segment 3, eh?
yeah, okay, we ready? Thank you for being with us today. This is Wise Money with Korhorn Financial Group. I'm Mike here in the KFG studios with Josh and special guest, CFP CPA Ryan Fair. Thank you, Bethel College Adult and Graduate Studies, as well as Diane Bennett from REMAX 100 for making the Wise Money Show possible. We truly couldn't do it without you. Thank you very much. We've been talking about tax planning and really the whole idea that every year you need to analyze what changes are going on in your financial life and with your taxes, and then capitalize on opportunities, new opportunities that exist, and avoid surprises. And guess what? Your tax picture changed this year. You didn't even need to do anything about it. So you need to be doing tax planning and a tax projection. If you have any questions about any of that, reach out to us, 574-222-2000. You can call us there. You can text us there, 574-222-2000. Online, wisemoneyradio.com. And then all over social media, just search Wise Money Radio, Facebook, Twitter, YouTube, all that sort of stuff. So we are right in the middle of, all right, Mike, you just said everyone's tax picture is going to change. Well, how? We're talking about for individuals. In just a second, we'll add small business owners to the mix, but talking about the changes for individuals. What else, Ryan? What it also is changing for individuals?
So yeah, we've talked about all of the child tax credit, the exemptions, all of that standard deduction changing. Standard deduction probably affects everybody, but what if you say, hey, I don't have kids? No, that other stuff doesn't matter. The tax brackets themselves change significantly this year, and that's going to affect everybody, regardless if you're retired or first year out of college or in high school, having your first W-2. The tax brackets themselves went down, so everybody is going to be paying less income tax percentage on their taxable income. So, and again, that's everybody. The ranges went up, the percentages went down, which means you can count on paying a less tax.
All right, so there's a trouble brewing here, but just to give you a feel, it used to be 10% and then 15, then 25 and 28 and so on. And now it's 10 still, and then 12.
Right, that's new.
And then 22, right? And then 24. So you're going to save, once you get past that 10%, you're going to save 3 to 4%, maybe even more because the tax bracket's a little bit widened on every dollar of taxable income. But okay, you might think, well, that sounds great. How could there be a problem? I potentially think there's a big problem.
Mm-hmm. And it has to do with those of you who are still working. Your employers, back in February, I believe it was, they started using new tax withholding tables. So out of every paycheck, they're withholding a certain amount to pay to the federal government on your behalf. They're prepaying your tax for you, essentially, but they're doing less of it now.
Yep.
They're not withholding as much money. And so it's almost as if you're receiving some of these tax savings throughout the year in tiny little bite-sized amounts that you may have not even noticed it happening.
Yep.
And so you're thinking, oh boy, at the end of the year, I'm going to get a nice size refund. No, you may have already received it throughout the year. In fact, some employers or some people's financial pictures are causing them to go from refund mode last year to maybe even owing this year.
This is not uncommon, right? And so you might be hearing about these good these new tax breaks and think, okay, I'm used to getting a $1,000 refund. With all of this, I'm going to get $2,000, and you show up and you owe $500.
Right.
That's very possible under the new plan.
Yeah, it is. For most people, it's working out okay from what we've seen, but there's definitely a crowd that it is going to impact more so than others. And so these withholding tables that Josh is talking about, that your employer is calculating federal withholdings each paycheck.
You mean part of the government conspiracy to control us, right?
Yes.
Okay, that's what you mean.
So that's exactly what I'm talking about. But those are released by the IRS that tells your employer, if they make this much, withhold this, percentage or calculation of taxes from each paycheck. And, when you start a new job or every year, every 10 years, you fill out a W-4 that tells your employer, hey, I want you to withhold based on those IRS tables, put me down for married and 2 dependents because I've got 2 kids, or 2 dependents because I've got no kids, but I just want you to withhold less. Based on, withhold less. And so before, the IRS tables prior to 18 would come up with a close approximation of how much the employer needs to take out of each paycheck, again, based on the $1,000 child tax credit, based on the higher tax brackets, all of the old laws. Now, if the IRS released updated tables in February, and for 2018, if they're withholding from your paycheck, married and 2 exemptions, the calculations they're just numbers that are telling your employer.
Right.
But the calculations are assuming, okay, this person has 2 exemptions, so they must get 2 of these $2,000 tax credits for their kids. And
the increase in standard deduction would have helped them, and they're only making X amount, and so we really don't have to withhold
Much at all.
Much at all. And so I'm actually concerned for the average person, and this isn't fear mongering. You just need to look at it and see, because I have just seen a lot of people where it's done exactly what I said, where it's I shouldn't say a lot, but enough.
Sure.
That you're used to getting 1,000, you think you're going to get 2 because of the tax breaks, and trust me, your taxes went down, but
Right.
your withholdings went down more, and now all of a sudden you're going to owe. So this is voice of CPA Ryan Fair talking about the tax projection and planning process and how lower taxes, but also lower withholding tables really could impact and surprise a lot of people.
Yeah, for sure. And like you said, we've seen it in the real world doing these tax projections. And so that's awesome to let people know ahead of time. Hey, you need to fix your withholdings, get back on track.
We need to talk about the impact of small businesses, because there's a huge one. I mean, really, this whole tax law change wasn't about the middle class. It was about small businesses, or businesses, I should say. But there's one other. If you're thinking, well, wait, I've itemized in the past. I've itemized, it's going to be more than 24,000, so I'll keep itemizing. There's no problem. I'm not going to worry about this. Well, there's a couple limitations within the itemized deductions that are changing, and I know we're running a little long on this topic, but can you just touch on those really quick, Ryan? Because that could surprise a lot of people too.
Yeah, a couple of them that you hear in the media all the time right now is the SALT deduction. So SALT is an abbreviation or a acronym for state and local taxes, SALT. And on your itemized deductions, you get to deduct your state and local income taxes, your property taxes on your house, and any excise taxes on your vehicles. Prior to 2018, you could deduct 100% of that as an itemized deduction. Part of this new tax law for 2018 on forward is they put a cap of $10,000 for that whole section of tax deduction on your itemized deductions. So that's capped now at $10,000. So that's going to impact the higher income earners and the higher property tax payers. That's where, usually the coasts are the ones that are complaining loudest about it right now, because, New York, California, they've got the highest state income tax rates. They've got the more expensive houses that they're paying,
Property taxes
of $10,000. Let alone, not accounting for any of the income tax. So
That's right.
we're in a good spot as far as property taxes go, and Indiana and Michigan are, reasonable tax.
But it could still impact you.
It definitely will,
coupled with some limitations on the mortgage interest, but also limitations on miscellaneous itemized deductions. I was meeting with someone yesterday who itemized last year at $34,000. But when you apply the cap to their SALT and you get rid of the miscellaneous itemized deductions, the deductions would only be $16,000.
Yeah.
And so they're going to lose a decent amount of deduction here.
So yeah, these miscellaneous itemized deductions that Mike's talking about, if you're looking at Schedule A, it's down in the bottom section of your tax form. But financial planner fees are not deductible anymore. Tax preparation fees are not deductible anymore. And then the big one is for the unreimbursed employee expenses. And so there's a lot of salespeople out there that cover their own expenses. They pay for all the gas in their car, their mileage, their attire, or mechanics that have to buy all their own tools and stuff like that. They're used to deducting a lot of these unreimbursed employee expenses that they're required to have for their job. That whole section is gone now.
Gone. So there again, this is going to impact you. You just need to find out how.
Yep.
I promised. They're big changes for small business owners. We're going to hit that next. Whether you own a business and you've got employees, or whether it's just you and you're self-employed, or whether you have rentals, big changes there. I've got 2 listener questions about taxes. Fans from the show, thanks for submitting those. I'm hoping to get to those as well with special guest Ryan Fair. That and more coming up here on Wise Money with Korhorn Financial Group. Sorry, I went long there, but I just...
It's important.
And we've hit it. Maybe this is our 3rd time this year talking about these changes, but it's just so
This
different.
is the time of year when they need another reminder, because if they haven't taken action yet, the year's getting short here. So, nice job, Brian.
Yep.
Thanks.
All right.
So we're
So,
going to hit the qualified business income deduction.
oh gosh, I
and
can't even
then
say it. I just say pass-through business.
QBID.
I don't know it yet, so it doesn't roll off my tongue yet. But yeah, we need to hit that. And I think who it applies to and essentially how it works.
Yeah.
If we spend the whole 10 minutes on it, fine. If we don't, and we can jump to hit one of the questions, that's great too. If we can only get to one question, I'm hitting Brent's. Because I'm getting this a lot. I don't know if you guys are. But hey, I keep hearing about these tax deductions. Do I need to pay this estimate?
Mm-hmm.
So, we'll see. But this is for segment, so.
So could you use Brent's to introduce the Q-bid?
Oh, yeah, Josh, see, he's always right.
So maybe you start with that one, and then we still hit the same content. Maybe we can get to both that way.
Man, smarty pants. Mm-hmm. All right. But I really never know what I'm going to say, so who knows? Maybe I'll do
We'll
that.
find out in a minute.
Maybe I won't. So, all right. Are you aware of all of the new tax planning opportunities available to you? And are you avoiding any potential tax surprises? That's what we're talking about today. This is Wise Money with Korhorn Financial Group, coming to you from the world headquarters of Korhorn Financial Group in the KFT studios. My name is Mike Bernard, here with me, Josh Gregory, and special guest Ryan Fair. Thank you for listening. If you've missed anything, you can catch up on every episode in a couple different ways. It's all on podcast. Every single show, even though it airs on the radio, is on podcast. You can find it wherever you listen to podcasts. You'll need to search the whole name, Wise Money with Korhorn Financial Group. That's Korhorn with a K. And while you're there, why don't you go ahead and like it if you do, and subscribe to it if you'd like to. You can also listen to every episode right there on the YouTube channel. That's a little more stimulating. You can just see us live in the studio. It's not, we're just sitting here talking, so there's nothing exciting going on. But I don't know. I have a lot of people who say they watch it on the YouTube channel. Mm-hmm. So just search Wise Money Radio. You can like and subscribe that and share episodes as well if you think the content's helpful. Lastly, online, wisemoneyradio.com. All the episodes right there. You can listen online. You can submit questions that way as well. So with special guest Ryan Fair here in the studio, we're talking about these tax planning opportunities. And we've got a couple of listener questions. I'm going to use one here to kind of line up our next discussion about how the new tax changes will impact small business owners. So fan of the show, Brent, he's 59 from South Bend. He says, I own a small LLC and I have 3 employees. My accountant has set me up to pay quarterly estimates. This is common if you own a small business or you're a salesperson, something like that. He says, with the tax changes this year, do I need to pay my 4th quarter estimate or not? So before we directly answer that question, why would he even be thinking that, Ryan?
Well, Brent's probably thinking that because of, all the hype of, hey, tax law or taxes are all going down. There's some new deduction I've heard of that as a small business owner, I get 20% of something. I've heard of that as a small business owner. So yeah, that's what Brent's thinking. And there's not an answer unless you do a tax projection. And that's the kind of the cop-out answer, but
no, that's a real answer.
It's a real answer. Because it depends if your accountant, when he gave you those the estimates last year, what they were based on. Did he already account for the decrease in taxes? Did he already account for this 20% thing that you've heard about, or are they based on 100% of last year? Mm-hmm. And that's the kind of stuff you have to see where reality is.
Are you making more money this year? Are you making less money this year? That sort of stuff.
Answers to these questions have to come from a conversation either with your CPA or with your certified financial planner. Ideally, it's with both, right? But we can't answer that because there is a new deduction that maybe you're hearing this rumor all about. It's called a QBID. Qualified Business Income Deduction, and it's for some of the folks like Brent who own their own LLC, a limited liability company. It could be a way for them to write off up to 20% of the profits from their business. But it depends on what type of business they're in, what their income level is. There's a lot of gotchas built into this. Mm-hmm. And in fact, this one issue, in my opinion, is probably the one that has had the most CPAs kind of scrambling throughout the year to get their mind wrapped around this. I would say that of the IRS. They've been kind of slow in coming out with guidance on this whole issue.
So yeah, the tax law changed back in December of 17 is when Congress passed all this stuff. CPAs and accountants have been waiting around for the IRS, saying, "How in the world is the IRS going to interpret this?"
Yeah.
Finally, in August of 2018, just a couple months ago, the IRS released a little summary of what they think that Congress meant and how they were going to interpret this law. It was 184 pages.
That is
That's
crazy.
their summary.
184 pages was the summary. So that's your warning about this whole thing up front. And then also, it's funny, continuing ed classes we're talking about going to all the time, there's full day seminars just about this one. It's called a Section 199A is where this stuff is located in the tax code. There's full day and half day seminars just on this 20% thing to understand. So
Part
we're
of it
gonna-
is
yeah.
part of it is understanding which occupations or which fields are allowed to use this new deduction and which ones got carved out, got segregated or eliminated from the code. I'll just tell you right now, with a little bit of gripe in my voice, both financial advisors and accountants got carved out of this one.
Not radio show host, Casey. You're good, I think.
I don't know.
Although I
Service-
gotta eat my word. So
Yeah.
Share a little bit more about that. Who's in, who's out, in really this gray area.
So yeah, who's in? Basically, all kinds of business entities except for C corps. So you could just be a sole proprietor, file with your tax return. Could be an S corp. Could be a partnership, LLC. All of these business types are, first up front allowed to look at this deduction. The stuff that we're making jokes about with Casey and the if they're allowed, service-based businesses have a different set of rules if you fall under this service-based. So service-based in the IRS terms means that the revenue for the business is generated primarily based on your individual output.
Efforts and
your effort
reputation and
right.
everything. Yep.
You're not manufacturing products.
Exactly.
You're not selling candy bars or RVs.
Yep. So what does this mean? The simple version is you're allowed to deduct 20% of your gross profit from taxable income and not pay tax on it. And that's the oversimplified version. The rules, if you're married and your taxable income is under $315,000, that basically is how it works. The 20% deduction. So if you look at your qualified business income, which is the profit from your business, if it's $100,000 at the end of the year and your total household taxable income is less than $315,000, you qualify. So that $100,000 of qualified business income, you take a deduction on your tax return for $20,000 that you don't pay tax on.
If you're eligible for the full 20,000. So you're eligible for the deduction, but then how much? Do you get the full 20%? You've got to jump through a couple other flaming hoops of IRS garbage in order to figure that out.
Yep. Yeah, and then so that's kind of the first threshold. Once you get up over $315,000 for a married couple, you're phased out between $315,000 and $415,000. So that next $100,000 of taxable income, which again is a little bit different for accountants because we're used to dealing with everything being adjusted gross income. This is taxable income, and so that means all of your itemized deductions come into play. One of the things that you're managing here.
I met with an architect just the other day for 3.5 hours. It was like 2 meetings in one.
One of your shortest of the week.
I know. We were cutting
Josh
it
has long,
close.
very long meetings.
A huge portion of the time was dealing with this specific issue. And we were able to conclude that an architect, even though he's in the service business and may have a great year this year, he's not going to be excluded because apparently architects and engineers did a better job of lobbying their senators than financial advisors and accountants did.
If you are self-employed, if you own a rental property, if you are a small business owner, you need to set up a meeting with your CPA right now. And my goodness, if you're preparing your own return because you're savvy and you're good with this stuff, you can't. You can't do. I'll just be bold and say you can't do it this year. You got to find a trusted CPA and sit down and talk to them about this because there's just so many changes and what ifs. So, hey, let's sneak in one more question here from Maggie. She's 54 from Osceola. She's currently saving 5% pre-tax, 5% Roth through her 401k. Someone told her that's a bad idea to do both. How do I pick one, or what do you guys think on that? Real quick.
I think it's impossible for someone else to know whether or not that's a bad idea. To me, it sounds like non-committal, not really sure which one's right, so I'll just do a little bit of both, kind of be diversified here. But there are some folks out there where splitting their contributions between a traditional IRA that gives them some tax savings right now, and maybe also combining that with a little bit of Roth contribution that will give them tax savings down the road. That could make sense if they're right on the edge of a tax bracket change, and maybe those pre-tax contributions help squeeze them down into the lower bracket. It might make sense. But the fact that Maggie's wondering tells me that this decision to split it wasn't based on an overall tax projection. That's the moral of the story for this entire episode today.
That's right.
Get your tax projection done. Now is the time to be planning what 2018 is ultimately going to look like for you.
Thank you for listening. That is all the time we have. If you have questions, reach out to us. You probably will. And so reach out to us in all the ways we mentioned, wisemoneyradio.com, 574-222-2000, or on social media. On behalf of special guest Ryan Fair, Josh Gregory, and myself, and all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.